target of 235 rupees on the stock.
All right, Mangalam, thanks very much for that. So that's Zomato for you. We'll have more on this one as the market opens. What do we have as far as first rates are concerned? Just a couple of seconds to go for market open. We'll sort of look at some of the earnings reactions and, of course, others as well, HCLTech and a few others, D-Mart and, stocks with news flow and more. So the opening bell, the first rates are on your screen. The Nifty is starting at about 24,573. It's a new high, of course. I think it's a new high. The Sensex is starting higher as well with 80,700 plus. That's a 150-point gain coming through. What else? Bank Nifty is up about 90 points, 52,366, 377. So Nifty Bank was the problem child on Friday. It gave up all the intraday gains, complete sell-off. But it's starting about 100 higher. And IT index is up about 0.65% once again. So, maximum focus on IT on Friday with a near 4.5% rally in the IT index. And it's another 0.75% gain this morning to boot. So this is a good-looking screen at the word go with a 60-point gain on the Nifty. Sonia.
So it is a very good opening. I mean, very good because we've had so many days of gains, right? And now we're building onto that. So the mid-cap index is up 150 points. The advanced decline ratio is solid at almost 1,500 stocks on the advancing side. Now, Zomato is a stock that is once again at a fresh high. It's been very strong lately, and this morning as well, Zomato is sitting at a fresh high. Then you have Tech Mahindra, which is at a fresh 52-week high as well. So Tech Mahindra is gaining ground. Talking about fresh highs, Britannia at 5,800 has hit a fresh high as well. It hasn't done too much this year, but Britannia is sitting on a fresh high right now, and the market cap has almost hit 1.5 lakh crores on Britannia. Inox Wind is another one looking pretty good over there. So these are just stocks that are hitting fresh highs. ONGC is at a fresh 52-week high as well. In the broader markets, a couple of other names on the upside. IREDA is the one that's gaining a lot of ground after very good growth that the company has reported in its AUM. And then you have HCLTech, which is now up almost 3%, post a good set of numbers. And something like a Zomato that I spoke about earlier. Geo Financial Services also looking pretty good. RCF, Hudco, Canara Bank, Yes Bank, PNB are also a couple of other stocks that are piling on the weight. So it's a good opening for the market.
Well, that's right, Sonia. A few more stocks on the broader markets that are doing well. EMS, they've got an LOA for a project worth around 140 crores from the Uttarakhand Power Corporation. So that one's opened up with a gain. EMS is up closer to around 5%. Piramal Pharma, the US FDA has issued zero form 483 observations and no action indicated designation for the company's Ahmedabad facility. So that one is well up closer around 4%. Another one that's moving well is Apollo Microsystems. They have been awarded a project by the Indian Army for vehicle-mounted counter-swarm drone system. So Apollo Microsystems, that stock as well, is up and about, up closer around 5%. GET&D, they have received an order of around 490 crores from Power Grid, but initial take on that stock actually was lower. I think the stock was down closer around 3%. So just pull up that one. In fact, that's opened up a little bit lower, GET&D. The other two stocks that are doing very, very well, we have Avenue Supermarts and V-Mart, both of them flying away. Remember, they've been doing well in the last week as well. And both those two stocks, they're up and about in today's trading session. So good start to trade. The Nifty Bank is underperforming yet again, but that's going to be holding the trigger from here on. Advanced decline ratio firmly in favor of the number of stocks advancing. Prashant.
All right. Well, it's a 65-point gain on the Nifty. 24,565 is where we are at right now. Let's just quickly look at some of the other names here which are jumping up. So I think we did mention IREDA. It's the biggest volume-led gainer, 7%. Okay, that's now 5%. IRFC is up about 5%. There is IFCI, which is up about 5-6 odd %. HCLTech is popping up with a 5% gain, so 1632 on HCLTech. Oracle Financial Services has got about a 3% pop. We've got Cyient, which is up about 3.33%. I think that tire price increase, I can spot Apollo Tire with a 4% gain right now. MapMy India, which is CE Infosystems, that's up 4%, 25.21 on MapMy India. There is Safari, the luggage maker, which is up 7%, 22.72 on Safari, and it's got decent sized volumes to show for it as well. We've got Zentech, which is up 4%, 13.50, 13.51. It's done fantastically well this year. Piramal Pharma is up 4%. Shakti Pumps is back up 5%. Stocks at about 43.50 or so. And you got Raymond, which is coming up with about a 5% gain as well. So, you know, it's a pretty decent start. Zaggle is up about 2%. EMS Limited, I can go down the list, but then volumes are a little on the lower side to begin today's session. On the downside, maybe a few other names. Asian Paints is down 2. There is Cochin Shipyard and Garden Reach Shipbuilders and GE Shipping. I mean, so the shipbuilders are all down 2.5%, but they've had such a huge move. I mean, you know, in 2024 so far. So that's, I guess, understandable. Mazgaon is another one. Yep, same sector, but 1 3/4% lower on Mazgaon as well. So all of these shipbuilders, and maybe we should put these stocks up down as an alert. Eris Life Sciences, the biggest loser with a 4% cut. The biggest volume-led loser with a 4% cut as well. Najib?
Just a few more stocks. You know, the reason that both Safari and VIP, both of them are higher, we have Investec. No, this could be a bit of a tailwind to both these two stock prices. They have initiated coverage on both those two stocks. On Safari, they have a target price of 2,800. On VIP, they have a target price of around 560. They're saying the industry itself will have a tailwind, and that's why they're expecting both these two stocks to do well. And just one point on IREDA, the stock listed in November, that's November 29th odd. The issue price was 32 rupees. So effectively, you've got a 10-bagger on IREDA. The high of the day was more than 310 rupees odd. What a dream stock. 8 months odd. If you got allotment in that IPO, which was fairly subscribed, you'll still be getting close to around a 9.5 to around 10-bagger in 8 months. That's the market we are in.
Oh, absolutely. And, quite amazing. Vineet Samir is our market master today. He's head of equities at DSP Mutual Fund. Vineet, good to have you with us here on the program. Thanks for your time. Appreciate it. You just heard some of these anecdotes and trivia, right? 8-bagger, 10 months and whatnot. I mean, it's just amazing. Once in a lifetime kind of market, right? And you don't get many of these. The question is, I think most people have made money to varying degrees in terms of what everyone's situation is different, what the starting capital is, risk appetite, and how they went about it. But broadly, I think one can say very few people would have been left behind. Are we at that point, Vineet, where you start to look at, protecting what you've made, and thinking on slightly more defensive lines rather than sort of, looking at doubling and trebling your money from here? What's your sense?
So Prashant, good morning and thank you for having me on the show. I think you have very rightly mentioned that at every interval one should always be thinking about one is growth, and then after a strong growth one should be thinking of how to protect capital. And clearly, if you look at the markets last 3 months, the quality factor has done well, and this is what actually we have generally followed over long term. At some points, it has hurt as well in terms of the overall performance. But I believe that the next maybe 1 year or so, we could see focus back coming back on the quality factor, because last 2-3 years, because of growth and followed by a lot of liquidity, we saw these up moves taking place across the segment. Now, most of the market is either expensive or very expensive. You don't have stocks which are really cheap in that case. So I would say that at least be focused on quality. Till the time the liquidity is driving the returns, it's good. But in any case, there are some issues which leads to market consolidation. Then also, I think we should be in good hands is what I believe.
Okay. But this has been such a phenomenal market, right, Vineet? If you map the last 1 year, so in the last 12 months, the returns that this market has given you, the Nifty itself is up over 20%. And I don't think any other asset class, maybe 25%, any other asset class has not given you this kind of returns. Do you think it's easy to replicate this kind of move? Or do you think that now the market could head into a period of time-wise correction, consolidation, until we get the next big trigger?
So Sonia, let's look at the data. So one is, let's go by the fundamentals first. The last 3 years, the Nifty earnings actually grew by over 25%. And now we are actually looking at growth, which is, let's say, close to 14-15%, which also I think is getting downgraded gradually. people are coming down to 12-13%. So I think fundamentally, what drove decent outperformance in the market was also, on the back of very strong earnings growth, which it itself is likely to see some bit of consolidation going forward on a high base. And anyways, some parts of the economy is still not, in the best form today. So I think considering all of that, we'll have some slowdown in the growth. And from that perspective, ideally, what you mentioned, market should see some consolidation, or at least investors should moderate their growth or the returns expectations from the market. Secondly, I mean, a large part of the market move has also been a factor driven by liquidity, which is also witnessed in terms of the P re-rating versus the earnings growth. If you make a comparison of the returns, if you break them down into how much of earnings growth has led and how much P has led to the overall return, the P re-rating has played a very important factor. And hence, I believe that, going forward, P re-rating may not remain as an attractive a factor for adding to growth. Earnings should, drive the incremental growth, and earnings themselves are in a sort of slow lane. So I would say that one should expect moderation, while flows continuing can do, any kind of, things. I mean, as what we've seen in the past few years. But I think as far as the expectations are concerned, we should have some moderation in the thought process.
All right. Hi, Vineet. Good morning and good to see you. And, just looking at the data that we get from the mutual fund industry on a month-to-month basis, and we were thumping the table with regard to the SIP flows. But if you look at cash levels, I'd say the top 20 mutual funds, well, that's gone up dramatically. We had the PPFA, mutual fund manager who joined us on the show, and they are at around 15-16%. Even Quant Mutual Fund, well, their cash levels are up nearly around 2 times in the last 6 months in comparison to what it was. Given this sort of liquidity that's coming in and the cash at various mutual funds, we're unlikely to see a big price correction. A time correction is more like it.
So, Nigel, I think the cash is just not lying in the domestic mutual funds, but also if we consider some of the international investors, they are also maybe waiting at the sidelines, because they also want to participate in the India growth story, and maybe are not as comfortable in terms of the valuation. So maybe at certain price points, they would also want to look at India more holistically. So you're right. I think which is where, you don't see deep cuts, small cuts leads to, good amount of flows. I think 4th June was a big, experience of that, where, after the results came out, markets ideally should have seen even sharper cuts, but it actually restricted itself at a, narrow cut. So I would say that a lot of flows which are wanting to be part of this growth story will mean that the markets will not maybe see deep cuts unless we have some very bad incident taking place. But otherwise, I think we should be overall doing well. And like you said, some time consolidation, some market consolidation should be there. But I mean, who can fight against the flows is what I can say.
Vineet, the budget is around the corner. Tell us what is your expectation. Actually, I want to know your wish list. What would you like to see happen?
No, so see,
I'm sure you have those conversations with your team as well.
Yeah.
So give us a flavor.
So I think in terms of my expectation, I would say that I'm looking at this budget from a very balanced perspective, because I believe, first of all, government does have good financial wherewithal to maybe do justice to their capex, what they were doing. Also, there is a room for some amount of welfare spends, which has been one of the important reasons where we have not seen the low income level or the mid income level actually come in the overall consumption as a basket. So I would say that beyond capex, which needs sustenance, which is very important for the overall markets and the industry growth. But I think that to create a balance, we need more, broad basing of consumption taking place. The low income, the mid income should also maybe come back in terms of driving the consumption, and any particular policy which actually drives, this part of the consumption should be a welcome step, is what I would imagine. On the taxation, I think there are various talks around the restructuring of the capital gains tax, rationalization of the various asset classes, bringing them all into similar periods. So I mean, all those things we'll have to see as it comes, what gets announced. But I think the capital gains tax or anything to do with the taxation on the equity is something which is going to create more sentimental volatility. But otherwise, I think in terms of the broad policies, I would want to see more broad basing of the growth metrics.
Okay, Vineet, we'll leave it at that. Thanks a lot for joining in. Appreciate your time here. That's the word coming in on the market overall, which, by the way, is holding out quite well. 24,500 is holding. The Sensex at 80,700. But HCLTech is surging on the back of its Q1 numbers, which was slightly better than estimates. My colleague Reema caught up with the management to discuss their Q1 performance, began by asking them about their annual revenue guidance. Listen in.
This guidance of 3 to 5% is something which we gave in the beginning of the year. And we did factor in the first quarter softness, which is quite similar to the previous years. And of course, Q2 is going to be a growth quarter, and Q3 is where we usually deliver peak performance. And at this point, we feel confident of the overall guidance for the year.
But you're confident about achieving that guidance, but do you think you will get to the upper end of the guidance, or is it going to be lower to middle?
We are confident of meeting a 3 to 5% guidance. No further qualifications of higher end or lower end at this point. Just one quarter is over, so probably next quarter we may fine tune it a little bit.
Sure. One more question. You've also said that you're seeing some early signs of discretionary demand bottoming out, but it's too early to call it with certainty. What are these signs of green shoots in discretionary demand?
If you see the verticals like technology and services, we've delivered a good sequential and good year-on-year growth. And I did call out these verticals even a couple of quarters ago that the pipeline is improving, and we expect to see some good momentum on this. So that's definitely played out. But having said that, in the last 7 quarters or 8 quarters, there has been kind of differing kind of signals that we've been getting, and sometimes the ramp-ups are very short cycle and things like that. So that's why I've not called out any pickup in demand. The demand situation remains pretty much the same as what we had talked to you 3 months ago when we gave the annual guidance.
Prateek, can you explain the margin performance? It's declined by 50 basis points, and with impending wage hikes, how comfortable are you with the margin guidance, or is there a risk to it?
Good morning, Reema, and all the viewers. I think, it is pretty much along the expected trajectory. If you see even our last 2 years, the quarter-to-quarter trajectory has been, the first quarter is the weakest, around this 17% in both the previous years as well. And then it's the second quarter where we pick up to, let's say, somewhere around 18%. And then the third quarter is the peak, driven by the software seasonality, which is our most profitable segment, as you know. And then the fourth quarter is kind of near the annual average, again, just like Q2. So that's the trajectory, and we seem to be following that. Given the first quarter decline in revenues, I think 50 bips decline is pretty much par for the course. So no special comment on that.
But there is an impending wage hike which will further put pressure on your margins. So are you still comfortable with the margin guidance, or is there even a little bit of a risk as the year progresses?
So the wage hikes, last year itself was a delayed cycle, delayed by a quarter for everybody practically. So we'll have to see what we do this year. We haven't still made the decision, as we discussed on Friday as well. So we'll have to wait and see, and we'll do what it takes, pulling out efficiencies from the business and to do the right things for the employees as well.
Okay. CVK, your deal wins, the TCV, total contract value, is down 14% on a quarter-on-quarter basis. And you said a couple of deals got pushed and delayed to Q4, though deal bookings will be pretty strong going forward. What was the reason for the delay?
Yeah, I think our overall bookings came in quite in line with our last few quarter trends. We've been clocking about $2 billion of net new TCV for the last several quarters, with the exception being the Q2 of last financial year, where we had a big spike in the deal wins. This quarter, we expected it to be a little more, maybe 2.3, 2.4, and a couple of deals got moved to the next quarter. It is really nothing to do with anything to do with the macro or anything like that. It is just that the logistics of getting an agreement signed got delayed, and we expect that to happen in this quarter.
And how is the pipeline compared to what it was 3 months ago?
Yeah. Pipeline remains pretty much at the same levels as what we had in the beginning of April. However, the pipeline also needs to be further qualified into the advanced stages in which deals are and things like that. So we feel a little more comfortable about improved bookings in the upcoming quarters. That's really what our takeaway from the pipeline analysis is.
Do you think this year, though, the deal wins in FY25 can be better than what we had in FY24?
I mean, you still have 3 quarters to go, and deal wins tend to be a little bit spiky in nature. So I don't want to take an overall call. But our overall expectation is we will have a better total TCV booking than what we had in the last year. At this point, it's just an expectation, but we have to see how it plays out.
So FY25 deal wins should be better than FY24. Prateek, you've also indicated the intent to hire fewer freshers this year. Can you tell us the reason why? Because hiring generally also has been subdued over the last few quarters.
Yeah, so I mean, we've called out a number of about 10,000. Last year, the fresher hiring was 12,000. So it's kind of in the same ballpark range, if you like. It's still early days, and let's say if things do become better, we could probably go over 12,000 as well. So we moderate it or monitor it across the quarters. Especially the off-campus is something that gives us flexibility to adjust those numbers in line with the growth and in line with the attrition as well.
And how is the attrition in the system? For you, the attrition picked up quarter on quarter?
I would say it is flattish. Yes, numerically, 12.8 versus 12.4 is higher, but I would say it's along that same 12 to 13 band that we have been, I think, for probably more than a year now.
CVK, coming to generative AI, because you've called out certain productivity benefits, I think 50% in BPO and testing, 10 to 30% in ADN, and up to 10% in operations. How is this going to play out? Will you have to pass on these benefits to your clients, or do you think it'll start reflecting in margins, or are you going to bid more competitively?
Yeah, I think there are multiple variables that play into the whole productivity paradigm. And I did also call out that some of these productivity goals that I talked about, it plays out over the next several years. It's going to be a journey where we start with putting together what we call as our HCLTech AI Force platform, which can be used to derive efficiency out of everything. IT operations, business operations within an enterprise. And it's a journey, and I mean, it will give you some year-on-year productivity, which is a little higher than what we had seen in the past. I think it's largely will get passed on. That's how I see it. There will be little areas where we may get some additional benefits, where we kind of agree on a risk-reward kind of arrangements. There could be some benefits that will accrue to us.
And just one final question about the near term, because you've called out Q2 is going to be a growth quarter. So tell us your expectations. Will it be better than what we had last year, even taking into account the impact of the JV divestment and individual in sectors and geographies? What is it that you expect?
Yeah, overall, we expect Q2 to be a growth quarter. In terms of verticals, barring financial services, we are expecting growth in all verticals. We also expect to grow in all geographies. However, two things to call out: financial services would decline because of the divestment that we had announced, and for the software business as well, it is a little bit weaker in the JAS July, August, September quarter. So I'm not calling out any specific growth percentage or want to say it's better than last year and things like that. Overall, it will be a growth quarter.
Okay, well, that's the word coming in from HCLTech. Let's step into a quick break. On the other side, we'll put focus on the big event next week, the union budget. Samir Kanabar of EY and Himanshu Parekh of KPMG India will be with us to discuss their tax expectations from the budget. Welcome back. Let's focus on the big event next week, which is the union budget. What are the changes expected with respect to the taxation? Will there be any income tax relief at all? Any capital gains tax on the changes on the cards? Himanshu Parekh, the partner tax at KPMG India, joins us now. In a bit, we'll have Samir Kanabar join us as well. Himanshu, good morning and thanks for joining in. You know, this time there is a little more fiscal headroom, right? Because of the kind of tax collections that the government has got, the kind of RBI dividend that was given out as well. So on the taxation front, is there any relief that the middle class can expect? Overall, what are your expectations?
I would think, yes, there is enough and more justification for the middle class to expect some relief from this budget. Now, if you see the tax regime as is applicable to individuals, you know, we have two regimes which are currently under play. One is the what we call as the old regime, which comes into play where taxpayers are entitled to several tax incentives, but with a slightly higher rate of tax. Compare that with the new regime, where hardly any tax incentives are available to taxpayers, but they have a concessional rate of tax across, more liberalized slab rates as far as income streams are concerned. Now, if you look at the new regime, the basic exemption limit for individuals is pegged at 3 lakh rupees. And I think it's time for the government to relook at it and increase that from 3 lakh to at least 4 lakh rupees. Similarly, if you look at the standard deduction that is available to taxpayers, that's a mere amount of 50,000 rupees per annum. And there's a high expectation from taxpayers that that standard deduction be enhanced from 50,000 rupees to 1 lakh rupees. If the government is keen to continue with the old tax regime as well, then there are expectations of taxpayers. There's a limit of deduction available under Section 80C, which has been stagnant at 1.5 lakhs since 2014. That needs to be suitably enhanced. And similarly, the deduction available on interest on housing loan, that has been stagnant at 2 lakh rupees since several years. And there's a need to enhance that as well. So a lot of expectations as far as on the personal tax front, as far as individuals are concerned from this budget.
Okay, since a large part of our viewers are retail investors, investors in the market, Himanshu, I just wanted your thoughts there because there is some expectation of allowing mutual funds to offer pension and retirement products with the same tax benefits as a lot of tax saving schemes like an NPS, for example, right? On that front, what can we expect?
Yes, that's a fair expectation, I would say. I'm not so sure whether the government will be inclined to extend that benefit to mutual funds which invest in pension schemes. But overall, I would say as far as the capital gains tax regime is concerned, there are a lot of expectations on the taxpayers to rationalize or simplify the capital gains tax regime. Today, if you see, the regime has become very complex in nature. Depending on the category of assets, the holding period thereof, or the residential status of the taxpayer, you have differential capital gains tax rates which are applicable. And this has made it a very, very complex exercise. So there is an expectation of taxpayers that the capital gains tax regime should be simplified, it should be rationalized. And the way it could be rationalized is to say, to bifurcate all assets in two classes. One is what we call as financial assets, and the second is non-financial assets. As far as financial assets are concerned, let there be a more relaxed or liberalized tax regime applicable to them. For example, on long-term capital gains tax, let the rate be 10%. On short-term capital gains, let the rate be 15%. Whereas for all non-financial assets, let the long-term capital gains tax rate be 20% with indexation benefit, and let the short-term gain be subject to tax as per normal rates. So a lot of expectations on that front in terms of rationalization of the capital gains tax regime. Then the one other important aspect in the context of capital gains tax regime is in the context of buyback of shares by listed companies. Now today, when listed companies do a buyback of shares through the open market through stock exchange route, the shareholder does not know to whom he is selling the shares. So the shareholder ends up paying capital gains tax on that. The company doing the buyback also ends up paying buyback tax on that. And in that sense, the same transaction ends up in double taxation. And therefore, there's a need out there to eliminate the applicability of buyback tax when it comes to share buyback through this mechanism.
Gentlemen, good morning. We have Himanshu, good points there. We have Samir Kanabar, who's also now joining us on the program. He's partner tax regulatory services at EY. Samir, good morning. Good to have you on the program. You know, a lot of the viewers who are watching are I think I'm not sure I'm echoing their sentiments. Of course, more tax saving through higher exemption, etc., is absolutely welcome, right? But I think the big way in which a lot of people have created money and wealth over the last couple of years is through, of course, stocks. So that has been the single biggest driver for the wealth effect, and it's been humongous. And I think that is the reason why there is a lot of sensitivity around this on taxation and how you tax stocks. Samir, should we expect, as Himanshu just mentioned, rationalization is what he spoke about, 3 different buckets, etc. What are your thoughts here?
Yeah, so, and of course, this is more if I just joined in a bit late, so my apologies, but is more from personal tax or is it more from corporate or both?
Personal taxation.
Personal. Okay. So, obviously, from personal tax, there are a lot of, I mean, if you look at pure economic data that has been released, there has been, nobody's now talking about that we need to expand the base. So we have quite a bit of taxpayers, which is around 6.5 crores. From 2 crores, we have moved to 6.5 crores. And hence now the discussions are that if we have more people paying taxes, and how do we sort of give back benefit to them? And that's where we are doing these discussions to say that, is there something that we can do more for the taxpayers and thereby increase the consumption story, leave more money in the hands of the people? Couple of things that come top of the mind is essentially, if you look at ESOPs, today the ESOPs are flavor of the day. And again, we are talking more from market perspective. A lot of companies are offering ESOPs. Now, today ESOPs are being taxed on the date of exercise. If this could be extended till the date of sale, obviously it would encourage a lot of people to sort of go for the ESOPs, because paying tax upfront without realizing any value becomes a big challenge. So this is something that I think government would be seriously looking at to bring taxation of ESOP, which is there, I think, today for startups, but not for all companies. So they should try to bring it at par from the date of realization. Second is, of course, if we can either increase the slab rates from 3 to 5, or can we increase standard deduction from 50 to say 125,000 rupees or odd. That would also leave a lot of money in the hands of the people. Some of other important aspect is that, you know, the housing related changes which had come earlier, where people had to, where it is more than 10 crores, people had to sort of not been able to take full advantage of investing in a new house. Now, if this can be sort of allowed for first house or one house, and this 10 crore limit can be sort of fixated for a second or third or subsequent houses, but not for the first house. That will make a lot of difference in the hands of the taxpayers. And of course, then can you allow housing loan enhancement from 2 to 3 lakhs or 4 lakhs, whatever it is appropriate, because today tax rates are quite high. Of course, we are looking at a lower tax regime, but we don't a lower interest rate regime, but we don't know when the rates will reduce. So that is something that we would be looking at more focused in a more focused manner. And of course, today you can only offset 2 lakhs of your housing property loss against your other income. If that gap can be removed and you can be allowed to set off all your housing property related losses against all your other income, then this would sort of leave a lot of money in the hands of the people.
Okay, just one final question from my end, Samir, and this is Sonia here. I think the bigger argument is how does the government broaden the tax base, right? Get more people under the tax umbrella. And on that front, what do you think the government can do?
So, and again, as I just articulated the economic data, we have moved from 2 crores to 6.5 crores, right, taxpayers. And if you have broad numbers, if you look at, there may be, how many taxpayers who have disposable income. It would be around, 25, 30 odd crores, or between 25 to 35 odd crore people who would be in the tax net. And then, of course, if you leave out the daily wage earners or contract people, then, you are around 20, 25 odd crores people. And out of that, say, you're saying 6.5 crores people are paying tax. Obviously, yes, you would still want to expand the tax base, not that you would not want to. Having said that, at least today, we believe that we are in a not that kind of worse situation as we were when there were only 2 crore taxpayers. So we are still in a better situation. Having said that, if government still proposes to expand the tax base, obviously something that government want to then allow is to keep the slab rates undisturbed, but then enhance the sort of standard deduction and thereby allow people to still continue to come within the tax net because the slab rates are still lower, and then still continue to file return and thereby encourage more people. Again, one more data that is there, which has been put up by income tax authorities, is that people who were, say, below 5 lakhs, who were paying taxes has reduced from 50% to 33%. So many people have actually moved into a higher tax bracket from 5 lakhs and above. So what we can do to sort of encourage them to sort of, give more income in the disposable income in their hands is something that government should focus.
All right, gentlemen, thanks a lot for joining in. Let's see what the finance minister has in store for us in the next 1 week or so. We'll know. And post that, we'll invite both you gentlemen, Himanshu as well as Samir, to join us and give us your first take on that. For the time being, thanks a lot for joining in. Well, time to get back to our special segment then, Quarter Se Quarter Tak, where we bring you the earnings expectations from each sector. Today, the focus is on the chemical space. Sonal joins us to tell us what do we expect from there. Over to you, Sonal.
Thank you so much for that. The big question for the chemical sector is when will we see recovery? This time around, it's going to be a mixed quarter for this sector. Raw material prices have stabilized for most companies in Q1, but Red Sea issues, they are driving freight rates higher, leading to better prices for some chemicals. And the lead time for both raw material sourcing and supplies of finished goods has increased significantly. While the commentary from management suggests prices have bottomed out, but a meaningful recovery would only be seen in second half of FY25. Let's take a look at some of the names. SRF will continue to see decline in PAT both on a quarter-on-quarter and on a YOY basis. The chemical segment will see some weakness, but packaging could see some improvement. For Navin Fluorine, it would be a decent quarter YOY, but CDMO will continue to be under pressure with prices for R22 lower. Aarti Industries will see profits rising 60% YOY on a low base because discretionary demand was very low last year. Let's talk about agrochemicals now. International agrochemical market remains under pressure from Chinese oversupply and pricing pressure.
And that's why UPL will continue to report a loss. While the volumes will pick up, this will be led by lower pricing. For PI Industries, growth will continue, though growth rates will come down. New products, excluding pyroxasulfone, may have been relatively subdued this quarter. The valuations will come up for you on the screen. Though we have seen substantial correction in pricing in stock prices as well, they still remain at elevated levels, somewhere between 29 to 30 times, barring UPL, which is one of the cheapest agrochemical stock and one of the biggest companies in the agrochemical space. But yes, this is what the valuation picture looks like here.
Discuss more on the Q1 expectations from the chemical space. Bhavna Israni, the research analyst at Anand Rathi Institutional Equities, is joining us. Bhavna, hi, good morning and thanks for joining in. You heard Sonal out on the expectations from the sector. Just wanted your thoughts on the chemical space. What are the 2 or 3 things you're watching out for, and which are the stocks that you're most bullish on now?
Yeah, hi, good morning and thanks for having me on the channel. Yeah, so as Sonal said, so Q1 FY24 last year, the performance was majorly impacted due to the destocking situation and aggressive supplies from China, which overall negatively impacted the volumes and prices both in the domestic and export market last year. So given the weak base, we would see year-on-year growth for the whole chemical sector on the back of export recovery and demand pickup in some segments. So we are seeing the demand improvement in performance chemical side, like more of pigments, polymers, paint, adhesives, and oil and gas chemicals. However, sequentially, performance is going to be a mixed bag as Q4 is seasonally a strong quarter for chemical companies. So we expect few companies like Atul, Aarti, Sudarshan would show some sequential growth supported by demand pickup in the discretionary segment. So on conclusion, year-on-year growth would be strong. However, sequential performance would be mixed bag and company specific.
All right. Hi, Bhavna. Good morning and good to see you in. This is Nigel on this side. I wanted your take on UPL. That's been a bit of an underperformer in comparison to the other stocks. Valuation-wise, there is some support. I'm not sure whether you'll have official coverage on that one. But post its exclusion from the Nifty, the stock actually has done quite well.
Yeah, so on the UPL side, so we are expecting that the demand in the domestic crop protection side would be better as compared to last year's, and the monsoon is going to be good. But however, having said that, the situation in the global agrochemical market is still challenging and headwinds are there. There is this destocking situation is currently going, pricing pressure is there. So might be there would be some more quarters to gain more recovery in the segment.
Okay, all right. Also, what are your top picks? I believe PI Industries, which has been a rank outperformer, they have done some inorganic growth as well. That's one of your top buy picks. Tell us more about that. Valuations are not very cheap, so I ask you.
Yeah, so as compared to if we see other companies, yes, the valuation looks fairly priced, and there is no been major correction on the sharp correction for various names in the sector looks fairly priced on the expectation. But yes, PI Industries has delivered better in the challenging time, and we expect that the company has the growth story and the sector and the company would perform better in the going ahead. So yes, we are bullish on the PI Industries.
Okay, you're bullish on PI Industries. Any stocks that you feel that, of course, valuations across the sector are at elevated levels, but any stocks where you have certain discomfort because of valuations alone?
Yeah, so if we see that Naveen, SRF, they are trading more than 35-40 times of multiple, and the recovery is prolonged. So we are expecting that the recovery would be majorly seen in the second half of the year, and which is going to be majorly driven by the agrochemical recovery. And the China situation, we currently not know that how they are going to pan out this season. So these are the factors, yes. So SRF, Naveen, there would be some challenges considering the major mix of the agrochemical side. And they have more of the generic products.
Got it. Okay. Well, we will let you go on that note. Thanks a lot for joining in. That's Bhavna Israni tracking the chemical sector. But let's get back to the market now. It is quiet, actually, not doing too much. The Nifty is up about 50 odd points. Mitesh Thakkar is back with us. Mitesh, welcome to the show. Your views on the index now, do you see it build on to its gains this week, or do you think that we could be entering a bit of a consolidation space? And also, what are the stocks to look at now?
So good morning again, Sonia. Every time I have called for a consolidation in the last 2 weeks, it's been sideways for 1-2 days and then made a new high. I think this rotational theme still is going on, and I think the IT names will continue to do well as they are doing today, and the banks could possibly be under some pressure. So On the Nifty, I'm not sure whether we'll have an immediate consolidation because of the strength in the IT pad, and I still expect the IT stocks to go higher, though we have results coming up in most of the stocks in the coming few days. But the overall trend looks very strong on the upside. So I think the way to approach this is that try to buy Nifty on declines around supports. So anything close to about 24,400 spot levels would be a good entry point. Avoid the banking names in the short term and focus on IT names.
Any of these tire names on your radar? C8 is up 6% now. JK is up 9%. JK Tire, that is. It'll come up on your screen. Apollo Tire. You already have trades here? Sorry.
Prashant, I have two positions in tire names. In fact, there is one recommendation also. So I have positions in MRF as well as Apollo Tires. MRF, we have futures, and Apollo Tires, we have some call options. But yes, I think good breakouts being seen over here. So I have C8 on my recommendation list. You just mentioned the stock. Keep a stop below 27.25 here. Look for targets of 28.75, which was the recent high. But I suspect eventually the pattern suggests that we might break beyond 28.75 and head towards 3,000 levels as well. So very positive bias on tire stocks. I've given my one recommendation, which is C8. The other one is a sell on ABB. You know, after a long time, there is signs of profit booking happening on the capital goods stocks, and ABB and Siemens both look to give a good pullback. So from a trading point of view, keep today's high 82.60 as the stop loss for ABB and look for targets of around 79.50, 79.30.
By the way, Mitesh, these shipbuilders, Mazgaon and Cochin and Garden Reach, even GE Shipping, I mean, they're all down 3.5%, 4%. Just, I mean, chartically, because, you know, these were in strong momentum and people would have bought them on the way up. This morning they are down. What would your recommendation be?
Prashant, you know, I think a very, very similar charts for all these stocks and a very similar technical setup as well. All these stocks have run up very aggressively in the last 3 weeks. They're extremely overbought, and now there are first signs on the hourly, 2-hourly charts of profit booking taking place. So my idea is that if somebody has been holding long, take profits or trail your stop loss to about 3-4% from the current price, which means that take a very tight stop loss and wait for a pullback to play out, this consolidation to play out. I think you will get them at lower levels in the next few days. Though the bigger trend still remains on the upside, in the short term, I think there is a good chance of a pullback.
Okay, we take a quick break on that note. On the other side, Manisha Gupta will join in to give us all things commodities. Stay tuned. Welcome back to Bazaar Morning Call. Well, let's go across to Manisha Gupta to find out what's the one commodity you need to be tracking today. Manisha, over to you.
Well, thank you for that, Sonia. I'm looking at metals as a sector because we've started Asia on a stronger note here. Last week was kind of uneven. We did not see all the metals gain up. Copper actually lost a percentage point in the previous week, but this week it has been on a firmer note and the markets are reacting to all the very positive data that has come in from China. So the industrial production at 5.3% on an year-on-year basis is higher than the estimate and has been on a stronger note as well on a month-on-month and a quarter-on-quarter basis as well. So that has been supportive. Apart from that, when you look at the China export numbers, that should come in on your screens, and that has been at a 15-month highs, 8.6% year-on-year gain coming in for that as well. So China production and export have been on the stronger side, but that's exactly where the stronger data from China comes to a halt. The imports have declined by 2.3%. So that tells you that within China, the domestic demand is not so strong, but the export demand definitely seems to be picking up. Now, when you look at the first quarter GDP numbers as well, were on the higher side. The second quarter GDP numbers have come in slightly at the lower side of 4.7%. And then the retail sales data has not been so great. Well, that's at a 17-month lows. The unemployment numbers in China also show an unchanged view there. So as I said, it's a half and half when you look at the Chinese numbers there. But because the production and the industrial data has been positive, well, that has been supportive for many of those metal prices. If you look at copper, aluminum, zinc, iron ore, steel, those prices are trading slightly in the positive right now. For copper, essentially, while of course the forecast of the demand going forward has been on the stronger side, the near-term inventories are much on the higher side. So when you look at the LME inventories, they have doubled in last 3 months. The Chinese production numbers have been up by 9.5% for the month of June. And that is the way the copper really seems to be behaving right now. Until the month of May, it was a $70 per ton of a discount to 3 months and cents of cash. Now that has gone up to $160 a ton. So that tells you that while the holding capacity and holding cost of copper has been on the higher side, it also has to do with the fact that the near-term demand on ground is not so strong. Is the reason we have seen the copper prices come off as well. So in the month of May, we saw all-time highs at $11,000 a ton. We are trading at below $10,000 at this point in time. What the markets will watch out for going forward is one, Powell testimony, well, that is today. And then it also is about China's third plenum meeting. That starts today as well. The focus is expected to be on debt and manufacturing. Well, this is a meeting that will set course for the next 5 years within China, so would be essential to watch out for.
Okay, thanks a lot for that. Well, let's talk about IREDA, which has been a big stock in focus. Abhishek is here to tell us more about that. Abhishek, over to you.
Well, strong business momentum has aided the results this time around, although operationally, if you take a look, the operating profits have declined on a sequential basis. So take a look at the AUM growth. It's at about 33.9% YOY and close to 5.5% sequentially. Quarter-on-quarter asset quality has improved, so gross NPA ratio has come down. Net NPA ratio has also come down by 4 to 5 basis points sequentially. Net interest margin has expanded both YOY and quarter-on-quarter, so net interest margin has come in at 3.29% versus 2.85% in the previous quarter. And our growth is at 37.5% YOY and about 5.5% sequentially. Now, operating profits have declined by 8.9% quarter-on-quarter. That's largely due to the fact that other income has declined on a sequential basis. There is a provision write back of 30 crore versus expense of 9.5 crore in the previous quarter, and that's aided the PAT this time around. PAT is up more than 30% YOY and about 13.7% on a sequential basis. Back to you.
Right.
Okay, thanks a lot for that. Well, I'm also watching out for some of the tire names because there is a price increase that some of the tire companies like MRF have announced. MRF has taken a price increase effective 18 July. This is to pass on the high raw material costs. And truck tires have been increased by 2%. Passenger car and radial tires have been increased by 3 to 7%. And that's why you're seeing the stock move up as well, because the company is passing on high raw material costs to consumers, and consumers are accepting it. There's no increase yet in two-wheeler tires, so perhaps that would come as well. The blended price increase works out to 2% approximately. And this is the first price increase by MRF. Apollo, SEAT, JK have already taken approximately 3% price increases. So this is the latest that's happening in the tire space right now. Let's step into a quick break. On the other side, in our special pre-budget show, Lata will connect with Sajid Chinoy of JP Morgan, Soumya Kanti Ghosh of SBI to discuss the big budget numbers to watch out for.
Hello and welcome to our pre-budget economist special. This is the show where we discuss the big budget numbers. How much may the final budget numbers differ from the interim budget? Does the finance minister need to change her revenue and tax assumptions after the excellent April-June tax collections? Is there space and need to spend more, especially after the election verdict? And finally, will the government target a lower fiscal deficit number? Joining me are two heavyweight economists, Sajid Chinoy of JP Morgan and member of the PMEAC, and Soumyakanti Ghosh of State Bank of India, member of the 16th Finance Commission. Gentlemen, thank you very much indeed for your time. Soumya, let me start with you. You're very busy, I know, with the Finance Commission work as well. But would you expect the Finance Minister to announce much higher tax estimates? We just have got the April-July tax estimates, and across the board, they're like, 19-20% higher than last year. But the interim budget had only assumed about 11 or 12% rise in taxes.
Yeah, thank you, Lata, for having me on the show. No, I think just to take a little back, the prerogative of this year's fiscal deficit, the budget comes against the backdrop of an impressive tax revenue and also the tax collections. But there are some things which the government used to address to, given the fact that the fiscal situation looks much better than what it was anticipated and significantly post-COVID. I think the first thing to look out for in the budget, and if you ask me, is that I think the RBI dividend numbers came it as a positive surprise to the markets, and I think to all the entire financial ecosystem of around 2.1 trillion. So my sense is that while the government is committed to a fiscal deficit number, as you know that the 4.5% is the fiscal deficit number which the government is projected by FY26 as per the new FRBM targets. My sense is that the government could actually look into a tax collection in the range of 14 to 15%. Basically, the nominal GDP growth rate in the interim budget is around 11%, and I don't see any reason to change that number. If you retain that nominal GDP number at 11%, that makes a nominal GDP growth rate of around, I think, 328 trillion. So even with a tax pansy of 1.2 to 1.3, which is eminently achievable given the current trends, I think the government can target a tax revenue of around, say, 15 to 16%. So overall fiscal deficit, which was in the interim budget pegged at around 16.9 trillion, could be reduced a little bit to around 15.9 trillion. But given the fact that there is buoyancy, GDP growth has been solid, the government could still target a deficit which is lower than 5.1%. So basically, it could be around 4.9 to 5%. But at the same point of time, the 2.1 trillion could be actually used to rev up the expenditure a little bit. I don't think the expenditure could be revved up beyond a trillion.
Yeah. I'll come to the expenditure in just a minute. Let's just do revenue first. Sajid, your take. We all know that the Reserve Bank was expected to give 80,000 crores. They gave 2.1 trillion. So there is that 1.3 trillion extra with the government. But will it be more than that? As Soumya says, he's expecting the government to have, almost 2 trillion more because of higher taxes. You agree?
I suspect it will be more. And I think the real story of the fiscal Lata over the last 5 or 6 years has been how gross taxes have evolved. Let's go back to 2018-19, before the corporate tax cut. Gross tax to GDP was 11%. That number fell when corporate taxes were cut. But because of efforts over the last 5 or 6 years, we've seen the GST has been kind of fixed and reformed. We've seen direct taxes have been very buoyant. The base has been normalized. We expect that last year gross tax to GDP was 11.7%. The actual numbers are now out. So we've seen 0.7% increase over the last 5 years, despite a corporate tax cut. And my sense is last year the government got a growth rate of about 13.5%. They were quite conservative, as the fiscal estimates have been in the last 3-4 years, very conservative, kind of under-promising and over-delivering. And so despite that 13.5%, the interim budget only kind of budgeted, 11.5% growth. I suspect that's what we'll get, that in the budget numbers that print, you'll still get conservative assumptions on tax growth. But because last year's base is higher, even if you make an assumption of 11.5% growth vis-a-vis the achieved number of 13.5%, tax to GDP will be even higher at 11.8% of GDP. So you get now higher RBI dividends and higher gross tax to GDP, even making very conservative assumptions. I think the bigger message, Lata, from this is that we come into this budget with the government having multiple fiscal degrees of freedom. And they emerge because first, apart from higher taxes, we had higher consolidation than envisaged last year. The deficit over the last 2 years has gone from 6.4 to 5.6. That means you now have less to travel. You've got to go from 5.6 to 5.1, A. B, you've got extra cash balances with you, which means borrowing can come down. And C, you now have the prospect of higher taxes and a higher RBI dividend. So there are multiple degrees of freedom.
Okay, no, I take your point. What Sajid is telling us is that last year's fiscal deficit was expected to be 5.8. We got the final numbers a few weeks back. It turned out to be only 5.6%, not 5.8. And that was because the tax collections were higher by about 30,000 crores. And that clearly comes into this year by way of a base. Saumya, I'm coming to the deficit because that's the big number the markets want. They want to know if the borrowing will be less. And I know both of you are urging to tell me that, but let's come to expenditure first. There is that election result which some people interpret as anger of the lower communities. And we know that consumption was lower. Even when we looked, if we pull apart the GDP of last year, it was almost entirely capex driven. Personal final consumption expenditure rose only 4%. So is there a chance that, overall tax bracket will be brought up from 2.5 lakh to, from 3 lakh to 4 lakh or something? Or, there is more rural expenditure. Do you expect bigger changes in the expenditure front?
Yeah, thank you, Lata. I think that there are two aspects to it. One, the next budget is actually also not even 9 months away. It's in the month of 1st of February. So I think the government could actually take a graded approach to fiscal reduction and, if required, to look into some sort of a tax incentive to boost up consumption. My sense is that the government in the budget could actually look into some sort of tweaking the agricultural sector reform, some reforms in the agriculture rural sector, which is pending for the last couple of years. I think for whatever reasons that has not been pushed, because that is one aspect. The second aspect is that I think there is two types. The roadmap is also of the direct tax, the implementation of the direct tax code, and the second roadmap is that overall the GST2 implementation. So my sense is that I am not expecting too much of an leeway on the personal income taxes front. Of course, there could be some giveaways here and there, because you all know that the government is pushing us to move towards a new tax regimes where exemptions are not available. So if I take that as the benchmark, I don't expect too much amount of leeway, but of course, the government can always go for lower personal income tax regime with the caveat that you have to move towards a new tax regime. So in my sense, some changes could come in the personal income taxes front, but there could be bigger changes or a bigger roadmap for the rural economy and also in terms of some of the issues impacting the MSME sector and generating employment in the budget. And that could be taken forward in February also when the next year budget is presented.
Fair point. Well, Sajid, your take. See, capex as it is, they have increased by about 25%, if I'm not mistaken, to 11.1 trillion rupees. And then there are some months lost during the elections. So would it make sense to really increase the capex budget? Will they even have the bandwidth to spend it in the balance 8 months? Or will there be a bigger thrust on, what a PMAY or any other kind of agricultural giveaways?
Lata, so the question is, there's about 0.4% of GDP in extra fiscal freedom that fiscal authorities have now that they did not have or when they were making the budget in February. And the question is, how is that 0.4% going to be spent? Will it be saved and the deficit comes down? Will there be some tax cuts or will there be some more expenditure? I'm in the camp, as you were alluding to, that we already have capex growth that's implicitly budgeted to grow at 17% this year.
Yeah.
And, that will take some doing of a higher base. So I think there are, absorptive capacity limits on capex. If you look at revenue expenditures, X of interest and subsidies, those were budgeted to grow much more modestly. If you look at what's budgeted over the actual number last year, it's only expected to grow at 3.5%. And initially, that was the means by which the consolidation was going to be achieved. Now with higher tax revenues and with a higher RBI dividend, the pressure of expenditures goes off. And so personally, I'd like to see higher spending on the revenue expenditure side, ex-interest and subsidies, for the reason that multipliers on the revenue side typically are higher than multipliers on tax cuts. When you have tax cuts, some of that tends to be saved. Of course, it depends on whose taxes are cut. So my sense is it'll be a balanced approach. We may get something on the tax side, something on the revenue side. But the larger point, I'll make one final point here, is, when people talk about a stimulus, we have to be realistic here that fiscal deficits are being reduced here. And so we want to make sure that we need to consolidate for sure, but we don't want to consolidate too quickly, given where private sector demand is. And here's the good news. Normally, you consolidate by higher taxes or lower expenditure. This year, because of the RBI dividend, a lot of the consolidation actually happens through asset sales, because a lot of the RBI dividend came from higher FX valuations and came from foreign interest revenue. So if you add that to what's already budget for asset sales, of the 0.5% of GDP consolidation this year, 0.4% occurs through asset sales, which is not contractionary. And that's the good news here, that we can have consolidation without compression. It doesn't have to be contractionary in the economy, and we still bring the deficit down.
Absolutely. Reserve Bank's dividend can't have come at a better time. And my sense is that they're going to give a big dividend next year as well, because people are only factoring in one rate cut from the Fed this year, which means Reserve Bank's reserves are going to continue to earn whatever, 4%, 5% invested in US Treasuries. We're going to get another dividend manna next year. But very quickly now, the big question to both of you, and if you can keep it brief. Soumya Kanti Ghosh, what is the deficit expected? How much can the market borrowing program go down if it goes down?
No, I think, Lata, there are two figures I should quote over here. I think I agree with the larger picture that aggressive fiscal consolidation may not be the need of the hour, given the government has comfortable fiscal space. So I expect the fiscal deficit to be, but still it should need to give a message to the market in terms of fiscal consolidation. So basically the fiscal deficit could be picked up around 4.9%, which makes it around the deficit, overall deficit in absolute numbers, lower than 16 trillion. So this would mean a net borrowing estimates to the market, which will be close to around 11 trillion, and a gross borrowing market estimates, which could be around close to 13 trillion. But these numbers actually could change if the government announces switches or other things in the budget. But my sense is that the government will go for consolidation, but at the same point of time, use the additional fiscal space to rev up the spending to some extent.
So how much does the borrowing, how much may the borrowing go down by?
So I think at 11.1 trillion, it will be lower than last year. If I remember, the last year overall borrowing was around 11.8 trillion in the interim budget.
Okay. So about 60,000 crore less.
Yes.
Got it.
Yes.
Yeah. Sajid, your best guess.
Very quickly, I think my expectation is still that the fiscal deficit will be close to the interim number of 5.1%. But the beauty of these extra fiscal degrees of freedom is you can have all three things happening. A, close to the same fiscal deficit. B, higher expenditure. But C, lower borrowing, because as we discussed, the government had about 1.5 trillion of extra cash balances than it had budgeted. Now, I think half of that is states investing in T-bills. There's about 70 to 80,000 crore of cash balances from last year's borrowing that were not budgeted, which can be used to bring down this year's borrowing. The question is, does the government do it on T-bills or dated borrowing? That is up to them. But you could have a situation where borrowing is lower, the deficit is the same, and you get higher expenditure. So in a way, you can have your cake and eat it too.
You can do it all. Oh, you're right. You're right. We could have the same 5.1 and you could still have lower borrowing. Take your point very quickly. I mean, completely, Soumya Kanti Ghosh, one or two other things that the government might notice. Please make it in 10 seconds.
I think some changes maybe on the rural sector. I think some of the policy changes which are pending, the government can just say we're going to accept those recommendations and act on them thereafter.
Okay, I thought you wanted them to tax deposits less in your report.
Yes,
yes. I mean, I got that. We have to, take that major point because capital gains is very contentious. Sajid, any one measure or two measures?
Yeah, I will be looking very closely at direct tax reform and how we can migrate people to the new tax code. The fact is, over the next decade, we've got multiple expenditure obligations: health, education, the energy transition. and deficits have to come down. So the only way to square the circle, to bring deficits down but increase necessary social expenditures, is to increase the tax to GDP. Let me give you one statistic, Lata, and end with that. Gross tax to GDP last year at 18%, central and states combined, is the highest that India has seen. So we've made significant progress on this front, but we need to do more going forward, given what we have to do on the expenditure side, on infrastructure, health, education.
Point taken. Many developed countries have 26% tax to GDP. So if you're going towards Viksit Bharat, then higher tax to GDP ratio comes with it. Thank you very much, Soumika Ghosh and Sajid Chinoy, for setting the tone on what to expect from the big budget numbers. We wrap up on this edition. Chartbusters coming up. Okay. Can I start? Yeah. Thanks very much, gentlemen. But viewers, don't go anywhere. Coming up is a similar conversation on the big budget numbers with Neelkant Mishra, the chief economist of Axis Bank. Yeah. Okay.